Welcome to The Explainer. Today, we're unpacking a massive financial roadblock, that huge, intimidating gap between the absolute safety of saving your money and the dynamic, sometimes scary world of wealth building. If you've been doing all the right things but still feel like you just aren't getting ahead, well, this is absolutely for you. We're going to break down the exact path you can take to turn those savings into investments completely without the anxiety and without risking your basic financial security.
Okay, first off, you did the responsible thing. I really want to validate that right out of the gate. Picture this. You finally start saving every single month. You move a little bit of cash into your savings account, $100 here, $200 there. You feel responsible, you feel disciplined, and honestly, you feel financially mature. You've built a safety net, and we all know that takes a ton of hard work.
But then, one day, you check your balance. Let's say you've got 10 grand sitting right there. Great milestone, right? But earning 0.5% interest means that after an entire year of hardcore discipline, you've made a grand total of $50. 50 bucks. That barely covers a decent pizza delivery these days. Meanwhile, you keep hearing everyone talk about investing and compound growth, and you start thinking, wait a minute, am I doing this all wrong?
Okay, let's dive into this. Here's the hard truth. Saving money alone is almost never going to make you wealthy. Now, saving is absolutely vital, don't get me wrong, but it's not the end game. Think of your money as having two completely different jobs. Side A is your savings, and its primary job is to protect your money. Side B is your investments, and its job is to grow your money. If you try to force your savings account to do the job of an investment account, you are going to be wildly disappointed.
The math paints a crazy picture here. Imagine a 20-year timeline on a $10,000 balance. If you keep it safely tucked in a savings account at a standard 1%, it slowly creeps up to about $12,200. But if you invested that exact same 10 grand into the S&P 500, which historically averages around 10% a year, you'd end up with roughly $67,000. Think about that. That is the exact same starting money, but a completely different reality. The biggest wealth gap usually isn't between savers and spenders, it's between savers and investors.
Moving to the psychology of risk. If the math is such a no-brainer, why isn't everyone just moving their money into investments? Well, the roadblock isn't the math at all. It's a psychological barrier built entirely out of fear.
You know the feeling, right? Saving feels safe, investing feels risky. I mean, in a savings account, your balance doesn't just mysteriously drop by 5% on a random Tuesday afternoon. But investments, they move up and down, and that emotional volatility simply paralyzes diligent savers. You don't want to lose your hard-earned cash, which is completely fair. So let's look at the 5-step path. This fear we just talked about is exactly why making the jump to investing shouldn't happen overnight. It really needs a staged approach. Consider this your personal roadmap to move from saver to investor without triggering massive financial anxiety. Here are the 5 actionable stages to safely build lasting wealth. Step 1, emergency fund. Step 2, mental separation. Step 3, start small. Step 4, keep it simple. And finally, step 5, consistency. Let's break these down right now.
Step 1. Build a solid 3 to 6 month emergency fund. Seriously, before you invest a single dime, you absolutely need this cash cushion of living expenses. Why? Because this fund acts as your emotional shield. The biggest reason people panic sell their investments at a loss is because life just happened. A busted transmission, a crazy medical bill, and they needed cash immediately. This emergency fund protects your investments from your own life.
All right, step 2 is mental separation. You've got to think of saving and investing as 2 entirely different buckets. Bucket 1 is your safety money. That's your emergency fund. It does not move. Bucket 2 is your growth money. This is the money you actually invest. The crucial trick here is giving bucket 2 the mental permission to fluctuate. Because its job is to grow over the long term, it is going to go up and down. Mentally separating these 2 buckets dramatically reduces your daily financial anxiety. Step 3 is where we actually pull the trigger, start small. You know, a lot of people look at the stock market and assume they need thousands of dollars just to play the game. You absolutely don't. Many platforms let you start with just 50 or 100 bucks. And listen, the goal here isn't to make massive profits on day one. The goal is just to build the habit. When you invest that first $50, you get to watch how it moves, you get comfortable with the process, and you conquer that initial fear.
Step 4, keep it simple. So many beginners make a huge mistake right out of the gate by jumping straight into day trading, crazy options, or crypto speculation, but honestly, simple almost always wins. Enter the index fund. These are incredibly simple investments that track the overall stock market. You get instant diversification because you own tiny pieces of hundreds of companies all at once. That means lower risk and steady, long-term growth. It's completely boring, and it works incredibly well.
Even legendary investor Warren Buffett has repeatedly recommended low-cost index funds for most investors. I mean, when one of the wealthiest people in human history tells you that the boring, simple strategy is actually the best one for the average person, that should give you a ton of comfort. You don't need a fancy Wall Street degree, you really just need a simple, low-cost index fund.
And finally, step 5, consistent investing and compounding. Seriously, the most powerful strategy out there is just showing up consistently. When you continually add to your investments month after month, year after year, you activate the literal magic of compounding. This is where the money your money makes actually starts making its own money. It requires discipline for sure, but give it time and the results are just staggering.
Now, what's really interesting is the visual proof of this compounding. It's absolutely mind-blowing. Think about a 25-year timeline, investing $300 a month at an 8% return. Your total out-of-pocket contributions equal $90,000, but the investment growth, a massive $195,000. Your total balance approaches $300,000, and the vast majority of it was generated by the market, not your paycheck. That, my friends, is the power of time.
Next up, surviving the market. Because at the end of the day, psychology really matters, and investing can feel incredibly uncomfortable when the news gets dramatic. So what actually happens when the market crashes? First things first, you've got to understand that market crashes are perfectly normal. They just happen. But here is a massive reframe for you. As a long-term investor, you actually benefit from downturns. When the market drops, the money you invest every single month simply buys more shares at a lower discounted price. It's literally like your favorite index fund goes on a clearance sale. When the market eventually recovers, those discounted shares lead to much stronger returns.
This is exactly why the experienced pros stay so calm during crazy market volatility. They follow one incredibly simple rule. Think in decades, not days. When you zoom out and look at the market over a 20 or 30-year timeline, a bad week or even a bad month is just a tiny blip on the radar. It's a temporary opportunity rather than an immediate threat to your survival. Think of it like this. Saving is like storing seeds in a glass jar. Investing is like taking those seeds and actually planting them in the dirt. Stored in a jar, they're protected perfectly. They are safe, but nothing grows. When you plant them in the dirt, sure, it looks messy at first. There's storms, there's rain, but over time, those seeds take root, they grow, and eventually you have a harvest that is exponentially bigger than what you started with.
So, to wrap up our core theses today, savings equals stability, but investing equals freedom. You absolutely need both. Your savings give you that solid bedrock, the peace of mind you need to weather life's storms. But combining that stability with the exponential growth of investing is what ultimately leads to a truly powerful, secure financial future. That's how you transition from just surviving to actually building wealth.
So, take a hard look at your own bank accounts right now. Are you just storing your seeds in a jar? Or are you finally ready to step out into the dirt and plant them? The choice is entirely yours. But remember, time is the one asset you literally cannot get back. Start small, separate those buckets, and let your money start working for you. Thanks for hanging out with me today, and I'll see you on the next Explainer.